Very warm welcome to everyone. Hope you guys are doing well and rocking in your life wherever you are. Before starting today's analysis, I want to know from you guys, did any one of you capture this move which I shared in yesterday's daily analysis video? I'm talking about this move. If you did capture, would request you to show your love from just liking this video. That's motivate me to keep sharing deep analysis for every one of you. Those who have missed this move, I am sure you are new to this channel. Press that subscribe button so you keep getting the premium setups for free. Without wasting any time, let's move on to today's analysis. What we are seeing here is a controlled institutional markdown phase. When we step back and observe the 1 hour time frame, the first thing that stands out is formation of a clear lower high near the 4820 region. This was not strength. This was distribution. Institutions used this reason to offload positions into retail buyers before pushing the market lower. The real turning point came when price broke below the 4640 level. That was the change of character, the moment where bullish structure failed and bearish order flow took control. From there, price respected supply zones perfectly. Notice the region between 4720 and 4740. That zone acted as institutional supply. Every revisit into this area resulted in strong bearish reactions, forming consecutive lower highs. This is a textbook bearish continuation behavior. Now look closely at the equal lows formed around 4660. These equal lows represent sell side liquidity, the stop loss cluster of retail traders. Institutional build liquidity before moves, not after. Once enough liquidity accumulated, price swept those lows aggressively, triggering stops and accelerating downside. Came the break below 4600, another structural confirmation that sellers remain dominant. Eventually, price delivered a fresh lower low near the 4520 level, confirming bearish continuation. From an institution perspective, this is not emotional selling, this is systematic markdown. Now the 4600 to 4620 zone becomes a critical resistance region. Above that zone lies buy side liquidity, stops from short sellers that institution may target before continuing lower. Currently price is consolidating, but this is not reversal behavior, this is liquidity engineering. Retail traders see support, institutional see opportunity. Low near 4510 remains vulnerable. As long as price remains below resistance, bearish continuation remains the dominant narrative. Let's go deeper into institutional psychology, because price does not move without purpose. Every consolidation phase you see here represents liquidity creation. Institutions cannot move market without counterparties, so they engineer zone where retail traders feel confident entering positions. Inside this consolidation zone, retail traders typically begin placing buy orders at perceived support levels. At the same time, stop losses accumulate below these levels. This is exactly what creates liquidity pools. Notice the repeated rejection wicks forming inside the range. These wicks are signs of absorption, sellers overpowering buyers without immediately pushing price lower. The behavior signals professional order flow. Liquidity exists both below and above price. Above resistance lies buy side liquidity, stops from short traders. Below weak lows lies sell side liquidity, stops from long traders. Institutions target these liquidity pools because they provide the fuel necessary for large moves. This is how every rally into supply zones results in sharp downward reactions. That tells us supply is still active, sellers are defending their positions, and buyers are failing to sustain momentum. Momentum behavior is also important here. Strong bearish candles with minimal retracement signal aggressive selling pressure. This tells us the dominant side of the market remains sellers, so the institution's narrative remains clear. Build liquidity, trap traders, sweep stop, and continue the trend. Now let's move on to the 15 minutes time frame to understand execution level behavior. This is where precision happens. On the 15-minute chart, we can see internal structure unfolding in real time. Price recently broke internal support levels, confirming short-term bearish continuation. However, notice the formation of short consolidation ranges. These are signs of liquidity buildup, not reversal. This consolidation is where many traders become confused. They see sideways movement and assumes reversal is coming. but institutions use consolidations to accumulate orders. The weak low near 4510 remains one of the most important levels in the market. Tend to be swept because they hold liquidity. Institutions rarely leave liquidity untouched. Also observe how price reactions after small rallies. Instead of continuation upward, rallies quickly fail, indicating bearish dominance. Momentum analysis confirms the same narrative. Bearish pushes are strong and decisive, while bullish retracements remain weak and temporary. At this stage, the market is not reversing, it is preparing for its next move. Now let's define the primary institutional sell setups, the one aligned with higher time frame bias. The key supply zone sits between 4565 and 4580. This region previously triggered strong selling pressure, making it an ideal location for institutional re-entry. The entry price sits at 4572, but not blindly. Price must first revisit this zone and show rejection behavior also. That rejection confirms seller presence. Stop loss placement sits above 4595 beyond the liquidity pool and structural invalidation point. If price moves above that level, its narrative weakens. The first target sits at 4525, targeting internal liquidity. The second target sits at 4510, the weak low liquidity pool. This setup maintains strong risk to reward alignments and follows institutional logic. Sell from supply, target liquidity below. Now let's define the counter trend bias setup. This is not a primary bias, but it becomes valid under specific conditions. If price sweeps the weak low near 4510 and shows strong bullish reaction, a counter trend opportunity emerges. The demand zone sits at between 4510 and 4520. Entry price sits at 4518 only after liquidity sweep and bullish confirmation. Stop loss placement sits below 4495, protecting against deeper breakdown scenarios. The first target sits at 4560, the nearest resistance zone. The second target sits at 4600, a major recovery level. Now here are the professional insights every trader must understand. First, never chase momentum. Institutions trap emotional traders by forcing them into late entries. Second, liquidity is not noise. It is roadmap institutions follow. Third, patience is the ultimate edge. Wait for structure, confirmation, and liquidity alignment before executing. If you master this mindset, you stop reacting and start anticipating. If you want to trade like institutions instead of guessing like retail traders, make sure you subscribe and stay connected, because tomorrow we continue with the next gold execution breakdown.